Hi everyone, Mr. H here. This is a video for both chapter 3.5 and 3.6, Profitability and Liquidity and Efficiency Ratio Analysis. Even though chapter 3.6 is exclusively dedicated for higher level students, I have decided to join these two chapters into just one presentation because they both cover one same topic, ratio analysis. So this is part one, and let's get started. In general, ratio analysis is a financial tool. It's a set of formulae that will help us to analyze and assess the figures we find in financial statements. So in the last video, we were doing balance sheet and profit and loss account. So those numbers, the numbers found there in those financial statements, can be used to analyze how well the business is doing from different perspectives. So ratio analysis in this presentation focuses on three important aspects. Number one, we focus on profitability. So we get profitability ratios. They show us how well the business is doing in generating profit. Okay, how well the business is generating profitability of the business to generate profit. In order to know that, to get those figures, we use the profit and loss account, and we have two very well-known ratios from this statement, for this document. Number one is the gross profit margin. The gross profit margin shows us how well the business is generating profit based only on the direct costs, the cost of sales. So in order to do that, we calculate, or we use the sales revenue, the figures of the sales revenue, and the figures of the gross profit. So the gross profit margin is the gross profit divided by the sales revenue times 100. What we get is a percentage number, and this percentage shows us how well the business is doing on making profit out of. I mean, how much how much from the sales revenue is profit based on just the cost of sales, the direct costs. If the numbers are too low, if the percentage is too low, there are ways to actually increase the gross profit margin. So a few solutions are shown on the right. For example, you can increase prices in less competitive or less price sensitive markets. I mean, we can sell at a higher price, but remember, this might actually affect the image of the business. I mean, the idea of you just raising prices and making things more expensive might make some people angry or concerned about the price, and they might stop selling or going to the competition. So even though increasing prices would, of course, increase the gross profit margin, you have to consider that it would affect your image. A second solution might be buy cheaper materials or find a cheaper a provider or supplier. Again, this is a good move to reduce the cost of sales, but you have to be careful not to affect the quality of your product by getting cheaper materials or buying from a cheaper supplier. A third choice would be to adopt more aggressive promotional strategies. I mean, you can start a marketing campaign, a promotion campaign that would attract more consumers, therefore more sales, therefore more profit. But you have to think that if you are spending too much money on that campaign, then you are increasing some other costs that would, in the end, affect your profit. You gotta be careful, especially if that campaign is not as effective as expected. And you can also promote staff efficiency or productivity. You can motivate the staff and focus on their efficiency or productivity. That might also mean, and this is the difficulty, that this might also mean that you might have to send some of your less efficient workers home, or just reduce personnel and focus on the ones that work efficiently. But these structural changes, these personal changes, might actually affect morale, reduce motivation. So you gotta be careful on that too. So these are four ways in you can actually reduce costs, reduce cost of sales, increase sales revenue, and therefore get a better gross profit margin. Okay. Another possible calculation that might be a little bit more accurate in understanding how well your business is producing profit is the net profit margin. The net profit margin uses two other figures. I mean, it uses again the sales revenue, but is focused on all costs. So you get the net profit before interest and tax. You're including both direct and indirect costs there, and related to the business, the business activity. And so what we do is the same thing on like the previous. We divide the net profit before interest and tax by the sales revenue times 100, and then you get again a percentage number. And again, it will show you more precisely, maybe because you're now adding more the other side of the expenses, the indirect expenses, the indirect costs, to get the ability to show the ability of the business to generate profit. If the figures, if this percentage is too low, then there are ways also to increase. Besides the previously mentioned tactics, these other two can help. For example, you can eliminate or reduce unnecessary expenses. Remember, these indirect costs or expenses are those that are not directly connected to the product itself, which means these are administrative or other kind of expenses, like for example, a holiday gift for all your personnel, or a trip for everyone, or I don't know, any specific benefit for your personnel. So you might want to reduce those unnecessary expenses. You have to analyze with your management team if you should reduce or eliminate those expenses to then reduce costs. But you have to be careful not to affect motivation by just cutting right away or unexpectedly those benefits that were given to your personnel, for example. So you have to analyze to what extent you can eliminate or reduce those unnecessary expenses. Something else that you can do is you can negotiate cuts with the stakeholders. You can negotiate to reduce some expenses there with others, like for example, paying less rent, or paying less for some specific services you are getting from others, from stakeholders. But you have to be careful that, for example, changing to a cheaper location because you want to reduce rent costs might actually affect the image of the business, even affect productivity or efficiency. So these are very careful decisions that have to be made. However, these are again good ways to make sure that your net profit before tax is higher, and then your net profit margin will be also higher too. So these are the two formulae for profitability ratios, okay, to tell how well your business is doing, and you get these numbers from the profit and loss account. The next is liquidity ratios, and this comes from the balance sheet. It shows us the ability of the business to pay off short-term liabilities. So you have to take a look at the short-term liabilities in the balance sheet, make some calculations there, and understand or learn how well the business is managing or how prepared the business is to handle short-term liabilities. So we have the balance sheet here, and one possible formula is the current ratio. Okay, the current ratio again shows compares the current assets versus the current liabilities, and shows how well we can cope with the current liabilities based on the current assets. Okay, the final figure, the final number that we get from this calculation is shown as in this formula, CR out of 1, current ratio out of 1. Keeping in mind that any less than 1 out of 1, okay, any less than 1 out of 1 is a dangerous figure because it shows that you have less assets or less total current assets to pay for the total current liability. So the idea is that it has to be higher than 1 out of 1 to be effective or to be successful. So we use these two numbers, the total current assets, total current liabilities, and with these two figures we calculate the current ratio. Okay, we just divide current assets divided by current liabilities. You should get a number like, for example, 2 or 1.7, for example, or 1 or 0.75. So we express those results in 1. For example, if my result is 1, 1 out of 1. If it is 2, 2 out of 1. If it is 1.5, 1.5 out of 1. And this is saying that for every dollar of current liabilities, we have $2 of current assets to pay for those liabilities. So it's actually very good if we are having 2 of 1. Even if we're having 1 of 1, it's acceptable, but again, the expectation is that we go higher than 1.1. It is way better if we get 1.5 out of 1. That's just excellent. Having too much of current assets, having a 3.3 out of 1, 4 out of 1, 5 out of 1, is telling that we're keeping too much stock maybe, or we're having too many debtors, and that is like you're actually keeping bad credit here by having too many too many debtors, or debtor with too much money, or you're having trouble with the stock and you're just keeping too much in stock that would actually eventually get obsolete or unusable, and then you are just keeping too much. So having a way high current ratio doesn't say actually you are doing excellent. A 1.5 up to 2 maybe out of 1 would be a good ratio, okay? Not a higher one. Now, what if we just do not want to consider stock? I mean, then we make another kind of ratio. But before we go to that one, let me show you what we can do to improve this current ratio. There are two possible solution or tactics we can apply. One way is to reduce overdrafts and seek long-term loans. I mean, we can reduce the current liabilities by reducing the overdrafts. Okay, instead of like getting indebted so quickly, we go on a long-term loan that will move the figure down here instead of keeping up, reducing therefore the current liabilities. But you have to consider that long-term liabilities will mean, again, is long-term. So it means that you are going to keep this debt for a longer time, and that would affect in the end your profitability. You can also increase cash by selling fixed assets. I mean, you can sell some fixed assets you're not using anymore, and then you can increase the amount of cash here. I mean, it's safer to increase cash rather than debtors and stock. So you can increase cash by selling some assets. But this means that you might also be losing some assets that in the end they might at some point eventually might become important for you, and you just got rid of them. So that's something to consider. And I was saying there's another way to calculate the liquidity ratio. It's a more accurate way, and this is using stock, total current assets, total current liabilities. What I'm doing is I'm subtracting the stock from the total current assets, just to consider cash and debtors as a means to pay for my current liabilities. So I'm just keeping my stock out because I'm supposed to sell it and get some profit. So I'm just focusing on cash and debtors to calculate total current liabilities, or the liquidity ratio. And so this comes from the acid test quick ratio. Is a similar formula. I just subtract stock from the current assets divided by current liabilities, and I get similar ratio. Okay, again, it has to be higher than 1 out of 1 to tell that we are doing fine. Again, it doesn't have to be that high either. Okay, and if I want to improve my liquidity ratio, my acid test ratio, this quick ratio, I can, for example, sell stock at a discount. I mean, if I want to change the number of stock, I have set a discount to pay off short-term loans, so I can sell a stock, since I'm not considering in this calculation, to pay these short-term loans. But remember, selling stocks at a discount will also means you are losing some profit, so something to consider. And finally, you can allow debtors to purchase more stock on credit. So you can increase your debtors, but this again would affect your business by keeping too many bad debts. So this is it for liquidity ratios. In the following video, we'll just focus on efficiency ratios, which has some standard level and higher level information. So this is it for now, and that's it.